Good afternoon, everybody. I want to make sure I don't have two mics on at once, just one, right? I'm Alan Blinder. I'm a professor in the department here, for anyone here who doesn't know that. And it is my privilege to introduce our speaker for today. I want to start with the most important part, which is that Loretta Mester has a PhD in economics from Princeton. During the course of which, if I'm not mistaken, she met her husband right here in romantic Princeton. We're just thrilled to welcome her back. After that, Loretta had a partial career, turned out not to be the whole career, at the Federal Reserve in Philadelphia, Federal Reserve Bank of Philadelphia, where she rose eventually to be vice president, executive vice president and director of research in 2010. She then went on to greater heights in the Federal Reserve to be the president and CEO is the proper titling of the, for those of you who don't know, reserve banks are not .govs, they're .orgs. They have CEOs. And Loretta was the CEO of the Cleveland Fed from 2014 until 2024, which of course makes you a member of the Federal Open Market Committee, among other things. And also in the case of Cleveland, the CEO of about 1,000 employees, which is not something we academics do or know about, but she does. She's also found time to be a trustee of the famous Cleveland Clinic and of the Cleveland Orchestra and a director of the Council for Economic Education. All of this adds up to it being a joy and a privilege for me to introduce to you Loretta Mester.
Well, Alan, thank you very much for that very kind introduction. And it is really nice to be back at Princeton, and it's very different than when I was here. The intellectual environment is just as stimulating, but the physical plant is pretty darn nice, I have to say, and different than when I was here. But remember, I was here 40 years ago, which, Farouk, as you know, that's a long time ago, right? So anyway, it's really, I'm very happy to be here, and I'm going to be visiting Griswold for the year, so I hope that I get to see and talk to more of you in my time here. So I thought I'd talk about the outlook for the economy and monetary policy, in particular for monetary policy. And when you talk about monetary policy, usually you're just talking about the outlook for the economy. Once you know what's happening in the economy, you know what's going to happen with monetary policy, or at least sort of. But I'm also going to talk a little bit about the outlook for the Fed, because as you probably know, the Fed's been in the news lately, not only for its monetary policy, but also because it's been under increased challenges from the administration. So I talked a little bit about that in terms of the outlook for the institution as well. So let me start first with what happened last week. So last week, the Federal Open Market Committee met, and as Alan said, that's the committee that makes monetary policy decisions in the United States, and they decided to cut the Fed funds rate by 25 basis points. Now, if you remember back in 2022, it seems like a long time ago now, but it really isn't that many years ago, headline inflation had reached levels we hadn't seen in 40 years, between 7% and 9%, depending on what measure you use for inflation. And so the Fed began then in March of that year to really increase the Fed funds rate, and it went very quickly up, right? So within the span of a little over a year, it had increased the Fed funds rate by 5.25 percentage points, which was very, very quick. Many said that we were late to the party there, which should have been increasing earlier, and I think I'm in that camp, that I would have preferred us to increase earlier. But once we started, we went quickly, and we got inflation down from those very high levels. And then after more than a year at that level, the Fed began to lower rates. And the Fed lowered them by first cutting by 50 basis points last September, and then followed that by 2 other 25 basis points cuts. So last week's cut, another 25 basis point, was the first funds rate cut or easing off of monetary policy since last December. So when the Fed makes these decisions, they're always doing the same kind of activity, which is they gather a lot of information. Many of the things they look at are data, the official statistics, but the Fed does a lot of its own gathering of reconnaissance as well. It runs its own surveys. It gets private sector surveys of businesses and consumers. It uses models. It uses a lot of analytical firepower, all to sort of come up with a view of where is the economy going, and importantly, what are the risks around its dual mandate goals of maximum employment and price stability. Congress gave the Fed those goals. When it comes together, it's looking at all the information that it can gather to sort of infer where the economy is going, and given that, what the view of the committee is of appropriate monetary policy. I think very important is for the Fed also to look at various scenarios. So they'll come up with sort of like where they think the economy is going. But as everyone in economics knows, that you can't be sure, right? Different things happen to the economy. You could be wrong, your model could be wrong, the data could get revised, there could be other shocks that happen. And so the real key here is to make sure that you're maintaining policy in a place from which you can then react in a way that allows you to sort of address the shocks as they come in. And I think that's an important thing of what's happening in last week's decision, is to make sure that the Fed has positioned its policy in a good place. I would argue that in 2021, we failed to do that. We left the funds rate at a very low level as inflation was moving up higher and higher and higher. And basically, the funds rate was much more accommodative than was appropriate for the economy. And then when we started to raise rates, we had to go very, very quickly, which has its own set of risks associated with it. Luckily, nothing, too dire happened there, but it's a risky strategy. So it's always good to make sure you're maintaining policy in the right place. So what's happening so far? Well, lots of things happened this year, of course. If you look at real growth, economic growth, it's one of the things the Fed will look at when it's determining where to place monetary policy. There's no doubt been a slowdown from the fast growth we had last year. So you think about last year, it was about 2.5% growth. This year, it's 1.5%. But the interesting thing about this year's growth, and I circled sort of what I want you to look at, is there was the pattern of growth. The first quarter, we actually had negative GDP growth or output growth. And that was followed by a big rebound in the second quarter. And whenever you see things like that, you have to ask yourself, well, what's driving that? That's kind of unusual. You don't really see that happening very often. And what happened was a lot of firms anticipated, given the election results, that they were going to be tariffed. And so what they did is they increased imports very, very quickly in the first quarter to try to beat the tariffs. Okay, and then the second quarter, once they had done that in the first quarter, tariffs went back to a more normal level, and you saw that rebound in GDP growth after that. If you actually look at, and then you can see other things going on. Residential investment, which is in that turquoise on the right, that's been very slow this year. On the other hand, equipment spending has been pretty good. A lot of firms are investing in AI and other technologies, and that's sort of driving some of the GDP growth that we're seeing. The third quarter estimate, and the Atlanta Fed puts out one called GDP Now, shows that growth is going to be like 3.25% this year. Of course, that gets revised every time there's a new data release, so I take that with a grain of salt. But what it's showing is that the economy seems to be doing much better, certainly than many economists anticipated it would do. And I think one of the things we learned over the pandemic, and we continue to relearn this, I think, is that the American economy is actually much more resilient than sometimes we give it credit for. And it's always good to remember that. When the pandemic hit, the predictions were incredibly dire. incredibly dire about what can happen. And I know we tend to forget that, and we sort of think about what happened, and in the end, we came out of it okay. But the beginning of that pandemic there were quite bad outcomes that were being thought could be plausible. So, so that's always good to keep in mind. That said, we have seen growth slowing, and consistent with that, we've seen hiring slowing. And in particular, I would say it's not falling off a cliff. That's a technical term. Not falling off a cliff, but if you look at sort of the monthly increases in firm payrolls, what you see is that it's really stepped down. So last year, the average pace was 165,000 per month. This year, the last couple of months, it's been under 30,000 per month. And if you talk to firms, what they're telling us, and I still get a chance to talk to a lot of firms, they say, we want to be very cautious in our hiring. We don't want to add a lot of people because we know we're going to face higher costs from the tariffs. We're already starting to see that. We need to protect our margins. So they're trying to be very cautious with their hiring, and that's showing up here in the actual official statistics. It's showing up in a lot of the surveys that the feds are doing. And if you look at sort of like tariffs and immigration, both of those policies are affecting the labor market. And if you look at transportation and warehousing, construction, they haven't had much growth this year at all in terms of their payrolls. If you look at wholesale trade, that also has not had, I think they've actually lost jobs this year. So some of the policies are actually showing up in the labor market in ways that you would expect. The other thing that's happening is there is this investment in AI. A lot of the results suggest that we haven't seen big productivity gains yet in many firms from that. But I point you to the fact that a lot of the firms in the years running up to the pandemic and even during the pandemic, because it was hard to find qualified labor, a lot of them automated processes. So, we talked to manufacturing firms in Cleveland, and they would be saying, we can't find labor, we're going to automate more of our processes. And I think that's affecting, also that trend is affecting the labor market, and perhaps will keep affecting it going forward. I said it's not falling off a cliff because even though those levels of payroll growth are much lower than we've come accustomed to, firms haven't really been laying off a lot of workers either. So if you have to think about what's going on in the labor market, it seems to almost be in a stasis. And Chair Powell, chair of the Fed, called it an uneasy balance. No, he called it a curious balance, I think. I call it an uneasy balance because I don't think I would call that a vibrant labor market. You want a labor market where people are moving and they're not feeling they can't quit their job to get a better job because they're worried that if they quit they won't be able to get a job. We're not in that place now. But on the other hand, unemployment is still low. And it did tick up 0.1% last month, but it's still by historical standards a low unemployment rate. And that's because of what's happening with labor supply. So again, another policy, of course, is the immigration pullback. And that's projected to continue. This is an estimate of net immigration in the CBO's forecast. So they do forecasts of this. And what you see is we're going to be basically, the big bump up we had in immigration is going to be much lower this year and going forward. And, you can sort of see in the statistics, if you look at, the BLS puts out statistics that are like native-born workers versus domestic workers. And over time, before the pandemic, foreign-born workers, and domestic. Foreign-born workers were 17% of the workforce. Okay? Now it's 19%. So they've become much more important, and their labor force participation is higher as well. So this is really a reduction in sort of labor supply, and that's what's sort of keeping, even though firms aren't hiring as much, you're not seeing it as big an increase in the unemployment rate because we have the supply changing as well as demand. And so to my mind, it's an uneasy balance. As the supply of workers comes down, you shouldn't expect to see the 150,000 jobs per month that we had prior, or even 200,000. A lot of estimates say that if you want to keep the unemployment rate constant, you probably only need 50,000 per month to be able to do that. So I think part of it, we have to re-educate ourselves in terms of when you have these structural things going on, what you thought was a healthy labor market prior is not necessarily the right metric. And so looking at ratios like the unemployment rate is probably a good idea. Looking at hiring rates, layoff rates is probably the right thing to be doing at this point rather than levels. But that said, 30,000 is probably lower than what is a break-even level, and so we did see the unemployment rate tick up. Now, of course, the other mandate is inflation, price stability, and good progress, of course, we've seen over time. But I would point out that inflation has been above the Fed's target for over 4 years. We were able to get it down, but it hasn't reached 2%, which is the target. And my own view is that there are upside risks to inflation. And I wouldn't want to see the Fed focus totally on the labor market and forget about the fact that we're in an environment where inflation has been elevated for a long time. Okay. If you look at sort of what's been happening over the past couple of months, this shows you 3-month changes in PCE inflation, so the personal consumption expenditure inflation rate, which is what the Fed's preferred measure is. And it looks at core PCE inflation as well, which takes out food and energy prices. That's been moving up, not moving down over the past couple of months. So to my mind, that's a concern. And then if you look at components of inflation, and here I'm showing you PCE inflation on the left and CPI inflation on the right, and breaking it into various components. So we're seeing tariffs affect prices already. There'll be more effects coming. Okay, so if you look at core goods, so take goods prices, get rid of food and energy because they tend to be volatile. Before the pandemic and that expansion before the pandemic, you saw inflation actually being negative, i.e. prices of goods were falling, of core goods falling. Of course, in the pandemic, it shot up. And, there's supply chain issues and all. It came back down, right? But now we're seeing it go up above zero again. So if you talk to firms, they all tell you, we've started to raise our prices, and they tell you even more, they're planning to do more of that. Because at some point, they're eating part of it in their margins by not passing on those prices to consumers. But some of it, they're going to pass on to consumers. And it'll depend on the elasticity of demand for their good. Some goods they'll be able to raise the price and not suffer from a loss of demand. Other ones, they may be more cautious. But everyone's expecting that we'll see prices go up on things that are tariffed. The Fed and others have been, and most economists, I'd say, think like the modal cases, we'll see a rise in prices and inflation will move up as those prices move up, but then once prices stabilize at the new higher level, inflation rates will move back down because we're not seeing prices continue to rise. And that's probably a good, modal forecast of what might happen. I think it's going to be much more drawn out than people anticipated it to be. We don't even have clarity on what the tariff levels are going to end up being. Some are still being negotiated. The Supreme Court has to weigh in on things. So it's going to be a drawn out, probably, process. But I also want to point out that that's just one forecast. And there's a possibility that this could result in more persistent inflation. And just as a reminder, the logic of that is very similar to the logic that we used for the supply shocks, right, after the pandemic. right? The logic there was it's a supply shock, right? It'll be a transitory increase in the inflation rate, and eventually once prices stabilize and the supply shock, firms adjust, right, inflation rates will come back down. Well, that logic is great for the textbook. It didn't work in practice, and so we ended up having to raise rates much faster because we waited, I would say, too long to start that process. And there's some research that has actually looked at this, like if the Fed had actually acted sooner, would they have had to raise the rate as much, or would the inflation rate have gone up as much? And some of the research just, no, we would have been better off. And the economy would have been better off. But I want to also point out that the tariff story isn't the whole story here. So the good news here is housing prices are starting to come down, the housing component, services component in inflation. So that's good. And that was a bit of a puzzle for a while because the rents in like new leases being signed were going down, but we hadn't really seen as much action on housing services inflation as we expected. But now that's coming down, and it's reflective of rents, and the lag is probably a little longer than a lot of previous estimates had been of how long it takes for those new lower rents to show up in the housing services component. So that's a good thing. The less good thing is core services excluding housing. Okay, and what you've seen there is, and the reason I wanted to show the CPI on the right is we have an extra month of data there. What you see there is that's starting to move back up again. Okay, now that could be temporary. It could be related to tariffs as well, because a firm may be offering services and goods and may feel like, okay, I have less worry about my demand for my services. I'm going to actually put prices up there, and that way I can eat more for things that have elastic demand. We don't know. But to my mind, that suggests that it's not just a tariff issue, that inflation has been stickier, right, than you'd want. And remember, the whole Fed narrative has been, right, temporary increase because of tariffs and inflation rates. And then after that abates, then inflation is on its downward path to 2%. And I would suggest that this says we should be cautious and at least entertain the possibility that that isn't going to be how things play out. Okay, so of course we know what the Fed did last week. They cut 25. What are they going to do going forward? Well, it really depends on what happens in the economy, of course. And in particular, a lot of the shocks that we're seeing sort of work on opposite sides of the mandate. The tariff shock, you could say, is going to increase inflation, right? But it also can decrease demand, which can hurt employment. So, this is the tricky and challenging issue here, is that not everything is going to move in the same direction. So the Fed 4 times a year puts out the forecast, summary of economic projections, and individual policymakers, so everybody, right, all the 12 presidents and the governors all put in a forecast. It's not coordinated in any way. There's no sort of sharing of information ahead of time. You just write down what you think, right, the path of the economy is and what's appropriate monetary policy given what you think is going to happen in the economy. And then what gets all the attention, of course, is the infamous or famous, depending on your perspective, the dot plot. Okay, so what this shows, and I've done something here that they don't do. I've put the dots on here. So each policymaker's dot of where the funds rate is going to be at the end of these years going forward. And then I've put on post on that the error bands that they show on a different chart, right? And this is just doing historical errors around it. So one thing to notice here is there are big error bands around this thing, and they'd be even bigger if I did it correctly, which is like anybody's dot has an error band around it, so the top dots have more. And I'm talking to Mark Watson here, so I'm nervous, I'm kind of doing a bastardization here, but you know what I'm talking about. So one thing to note is there's one dot in this year that's well below and we know whose dot it is, right? It's the new governor's, Steve Myron's. But the point here is that the Fed is concerned about, more concerned about the labor market than it was before, and maybe less concerned about inflation than it was before, since it's seen less pass-through inflation rates. And so the whole path going forward is a little bit more accommodative by 25 basis points, the median path across everybody. But the other thing to note is that it's very spread out, right? There's differences of opinions. Like, that median dot is 2 more rate cuts this year, so October and December, but there's very little difference separating the group that says 2 or less this year versus 2 or more this year. So there's a big divergence of opinion among the policymakers about how things might play out for the rest of the year. And we're starting to get different policymakers coming out and doing interviews and speaking to us. You know, some are more worried about the labor market. Others are saying, I don't even want to support any more cuts this year. So I think it'll be very interesting to see how their views are shaped by actual what's happening in the economy. And I'm very convinced that they will be very much focused in on the actual evolution of the economy going forward, and then using that to inform their policy views. And I think one of the key questions are going to be, do they feel that the labor market is deteriorating enough that they need to actually move policy from what is arguably a bit restrictive now to an accommodative stance? Or, right, do they want to maintain a somewhat restrictive policy stance in order to put downward pressure on the inflation rate? And I think the move they made last week was really like an insurance move. I viewed it as more of an insurance cut. They cut because they were worried about the labor market, to give a little bit of, support there, but they wanted to maintain restrictiveness in order to make sure that, inflation does start to move down again. Now that balance is going to be tough, partly because there's a lot of structural things going on in the economy, as you know. And some of those structural things mean that, the equilibrium interest rate, the interest rate that really determines whether, you're accommodative with your policy or restrictive with your policy, is not necessarily the same as it was before the pandemic. And I think if you look at the long run nominal Fed funds rate projections of the committee, which are shown there on the right, you see a pretty big disparity there. It goes from 2.6 to 3.9, and prior to the pandemic, everything was clustered around 2.5. So that spreading out matters, because the way people are viewing policy as being restricted or not is dependent on not necessarily long run R-star, but an equilibrium interest rate. And I think some on the committee think that policy is not very restrictive at all right now, and others think that there's still room to cut. So why might we think that R-star might be higher? And I should point out that Steve Myron, whose dot is the low one there, and I think he said his dots are the lowest across here, believes that R-star is actually lower, right, very low, whereas others on the committee thinks it's high. My own view is that it's moved up. And part of it has to do with sort of the determination, some of the factors that determine that long run equilibrium or natural rate of interest. And one of the determinants, of course, is productivity growth. And I guess I was a little skeptical at first when I saw these high productivity readings, because we know quarterly productivity readings are notoriously, variable. But this seems to have lasted long enough that I think there's something here, that we probably might have like a higher productivity growth. Although there's some economists who do a switching regime model between a low productivity and a high productivity, and they haven't switched yet to high productivity economy, but the probability of being low in that low state right, has gone down. So, maybe we're moving towards higher productivity. Anyway, again, I think the generative AI and all that stuff could very well be part of this going forward. I think a lot of the automation that firms already did was part of this as well. So, my view of this is very, there's good reason to think that maybe we're just in a soft patch in the economy and that the economy will actually pick up some steam at the beginning of next year. People are going to get tax refund checks that are much bigger than they're anticipating. That'll support consumption. Investment is still doing pretty well. If we do have sort of a higher growth rate, maybe because of productivity growth, that means that necessarily isn't going to be adding to inflation pressures, right? But if we have a higher potential growth rate of the economy, it also means you have less, room to ease policy, right, before you're at neutral. The other reason you might think that the R star or the natural rate is higher is because of what's going on with the budget and the budget fiscal policy in the United States. And, projections are that we're not on a sustainable path at all, that, we're going to get higher debt to GDP because the deficits are not going to come down. And that basically means that to get people to want to hold government debt, you're going to have to pay a higher interest rate. So there's various ways to get back on a sustainable path. Wharton has a model where they put out sort of like paths to get back to sustainability. And there are actually a bunch of things you could do to actually get there. But you need the political will to do it, and I'm skeptical that we're going to have that political will until something bad happens. Let's hope that we don't get bad things. Of course, the other way to handle that debt is to inflate it away. And you can do that. I mean, the administration actually has said that that's what they want to do, right? They basically said, we want to put a lot of people on the Fed who want very low interest rates because it'll lower our borrowing costs. So I was kind of surprised that was actually articulated, because to me it's sort of like, oh my God, we're going to say that out loud, even though everyone might infer it, that that's what's going on. But the fact that it was said out loud was very interesting. And the unfortunate thing about this is it comes at a time where the public had already lost some respect, I would say, and some confidence in institutions like the Federal Reserve. And, typically you'll see this happen during crises. During crises, the public usually, finds that they have less confidence in institutions. So the left hand, these are Gallup numbers, and this is you can just see that, things have deteriorated. And the right-hand side is they also deteriorate at the Federal Reserve. People are, less enamored of it than they used to be. I should say that this is not just the Fed, right? This is also happening at other central banks. Bank of England saw the same thing happen. European Central Bank, same thing. Less public trust in these institutions. And partly it's what I said before, which is when you have inflation rates go up as much as they did, right, and the mandate of the central bank is price stability, no wonder that could happen. But the other thing is, not only was inflation high, we kept misforecasting it. And so what I'm showing you here is the SEP, which I mentioned before. Part of what you're asked to project is, what do you think inflation will be at the end of each year? And we do it 4 times a year. So in 2021, right, so inflation really started moving up in the spring of 2021. Okay, every forecast we put in, the path of inflation that year was moved up higher. The data came in, it was like, oh wow, we underestimated inflation. You had to, it moved up. And even at the December forecast, we still were underestimating what inflation actually ended up being. Same thing in 2022. So the forecast errors also didn't help in terms of is the Fed doing a good job? And the third reason I think is because depending on which measure you look at, and I wanted to show you both of these because it does matter, as inflation was moving up, prices were moving up. Now, wages were also moving up, right? So that's the good thing. But wages, if you use CPI as your measure, and average hourly earnings, people are not as well off as they were before the pandemic, before the surge in inflation. So go back to March of 2021, right, or the first quarter of 2021, and just say, okay, did prices outpace the rise in wages? And by the CPI measure, yes. So you're still not as well off. You don't feel as well off. You aren't as well off by that measure. And so I think that combined with high inflation, the fact that we missed on the inflation forecasting, right, and I'll say we because I was there, we missed on the inflation forecasting and, right, wages just didn't keep up. You can understand why people don't have, feel that the Fed had done a good job. Now, bringing inflation down, the fact that inflation has gone down to 2.5% to 3%, depending on the measure, that has helped in terms of, the reputation of the institution. But these attacks from the president on the Federal Reserve, again, is in an environment where we already were in a deficit in terms of credibility, and it matters. So we've learned a lot about central banking over the years, and we've learned a lot about what makes monetary policy effective. And one of the principles on which policy is effective is independence to make those monetary policy decisions independently from short-run political considerations. And the value of that, right, is that you have the policymakers who focus on the goals that they're given by the government, right? It's a long-term, monetary policy affects the economy with, long and variable lags, as they say, but it takes a while for policy to affect it. And you don't want policy to be misset or inappropriately set for goals other than price stability, and for countries that have it as part of their goals, maximum sustainable employment. And governments often, and this has been true in the United States, even after the accord between the Treasury and the Fed in 1951, which said we're going to let the Fed set monetary policy independently. Presidents have tried to control every so often the policy that the central bank, wanted to do. And, they're both Republican presidents and Democratic presidents. Often they'll want a low interest rate before an election because then they gin up the economy, looks great. Inflation happens later, they don't care. The government's going to be biased to wanting to keep their borrowing rates low. Another reason that maybe the interest rate will be lower than you expect. The danger with this, though, is that study after study after study in lots of countries show that if you allow the policymakers to set policy focused on their goals that government gives them, then you get lower inflation, you get more stable inflation, and you're not paying a price with more variable output or employment. So that's what the studies show, very valid over the last 20 years. And what you see is, if you look at sort of measures of independence of the central bank, and there are ways of measuring that many countries have let their central banks become more independent because of this beneficial impact of the independence. So I think what we've learned over the pandemic and in this period is that even if something is a social norm, right, and even if something is supported by Congress, you should not take your independence for granted. That you cannot be complacent about it. You should always be thinking about ways that you can maintain independence and explain to the public, because you work for the public if you're a central banker, why it's important to be independent and then to be held accountable if you don't do a good job. and to go before Congress and explain, here's what we missed, here's how we, messed up on our inflation forecast, here's what we're doing about trying to get back to price stability and full employment. And my hope is that we'll get through this period of challenge to that independence with a stronger institution going forward that is one that maintains independence and accountability to the public. So thanks. See, they kicked me out of the thing because I was too old, but I can still step up that.
You could, you just showed it. Mic? Thank you. I'm going to turn the mic on, I hope. Yeah, that should do it. That should do it. Yeah, that did it. First of all, thank you very much for that tour de force. I felt like I was in an FOMC meeting, on the better end of FOMC meeting. There was a range and everything. Anyway, I want to start where you left off with Federal Reserve independence, and I think I don't have to explain why I'm starting with that, given what's going on. So, I'd like to hear how serious you view the current threat to Federal Reserve independence, including, among other things, I'm probably going to leave something out, putting someone on the FOMC who's also wearing a White House hat, trying to fire Lisa Cook illegally, almost certainly, and even threats to the Federal Reserve presidents, which until pretty recently you were one. Just to name a few non-random threats to the Federal Reserve's independence.
So I am, Lisa Cook, let me start with the Lisa Cook situation, right? Here's the problem with the Lisa Cook situation. If the Supreme Court allows the president to fire Lisa Cook, what that's saying is the Supreme Court is allowing a president to accuse somebody of something and get rid of that person.
Yes.
That means there's no independence left, because that means the president can fire anybody by just accusing them of doing something that he or she doesn't like. So to my mind, that is like the key, that rises above the other things, that if that is allowed to happen. But I'm also hopeful that that won't happen, in the sense that earlier in the year there was the cases of independent agencies where the president wanted to fire the independent agencies, and in that the emergency order that allowed him to do it, it's made a point of saying, but the Fed's special. And it went through this thing about, they're special and we would treat them differently, kind of, or implicitly treat them this way. They did not need to put that in.
No.
Okay, that was just sort of like out of the blue. So to my mind, that gives me some hope, not total despair, that maybe when it comes down to having to make a decision, they will make the right decision.
Yeah.
So that's a good, so I see things on both sides. The attacks on Powell in April about firing him, the markets went nuts, right? And he backed off of that. What I think is interesting is that financial markets have not really reacted that badly to some of these things going on.
And to Lisa Cook in particular.
And so that, and I talk to a lot of investment people now. I have the opportunity to do that. And one thing I've learned is how short-term focused they are. Like, all they care about is what's going to happen at the next FOMC meeting, if that. But what that means is there's potential that once something does happen, we're going to see a big change, right? It's all going to happen at one time. And that, to me, is kind of scary. I don't think that's not a good way to run an economy. So I think the Fed should be worried. I mean, the Myron thing is interesting because it's totally inappropriate that he goes on leave from CA. Totally inappropriate. And I see that very different from, there are so many people are making the analogy of Lael Brainerd going from the Fed to Treasury. I don't see that as at all the same. I see that totally different.
Lots of transitions have been made from the White House
Right.
to the Fed,
Right.
but always severing the relationship
Right.
completely. I was a case. Ben Bernanke was a more important case.
Well,
Much more
A
important.
different case.
More important.
But the other thing that is why this matters is even if they don't fire Lisa Cook and she ends up staying there, and even if every member, including Steve Myron, is really doing economic analysis, looking at the data, doing all the work that we say, only caring about the dual mandate goals, the institution's credibility has been reduced by these attacks because you're never sure. You're asking the question, right? Suppose Lisa Cook at the last meeting had wanted to cut 50 basis points. Just say she looked at the data and said, this is the right thing to do. If she had done that, I'm sure there will be people saying she's only doing that to try to get Trump to be happy with her, right? And suppose another person on the board had decided, I really can't vote for a 25 basis point. I've got to keep rates where they are because I really think that's the appropriate thing to do. Everyone's saying you're doing that because you hate Trump. This is the problem with it. No matter what happens now, right, there's more of a deficit of credibility that the Fed has to rebuild. I mean, I'm pretty hopeful that they will be able to do it because they're going to do the right work for setting policy, but it still makes it a much more challenging situation. It's already a challenging situation given the shocks on the economy and the dual mandate goals moving in different directions. This makes it even worse, harder.
I take that to be an answer. You see it as a serious threat, which I do. I wasn't going to ask you to put it on a scale of 1 to 10,
Okay,
and I'm
good.
not going to. But it sounded more closer to a 9 than to a 1 to me. But we'll leave that aside.
Yeah. And it's like when you go to the doctor and they say, what's your pain? Like, what the hell's that? I mean, how do you say what that? I never get that.
They want a number.
I know.
The docs.
But you have no basis for like knowing.
I know. Say 10. No, don't say 10. I want to move to a different subject which you brought up in several contexts in your talks, which is tariffs. I think you almost answered this, but I want to put a finer point on it. The tariffs look to you like a garden variety supply shock like we got accustomed to with oil, say, or as something different. One obvious difference, which was in one of your slides, is you don't see it by the discrepancy between core and headline inflation anymore.
Right.
We got used to looking at that over many years. You don't see the tariff. That's not the way the tariffs are going to play out.
Well, tariffs are more like a tax, right? So they're going to dampen demand, right? But they're going to raise prices. Now, I think the textbook case would be, it's in terms of the policy response from the Federal Reserve would be, look through it, temporarily high inflation, it'll stabilize.
Yeah,
and
that's
then
the question.
Come down. So I think that's probably, most economists would say, yeah, that's probably, but I take some pause there. Oh, and the other thing that I think is going well is businesses did learn during the pandemic supply shocks to be much more flexible in their supply chains. And I think they've been able to handle this better than anticipated. So that's good. Although we haven't seen the full effect because we don't know what the full set of tariffs is going to be.
Yeah, especially for China.
Right, exactly. So again, cautiously optimistic, businesses did learn. But I do think you have to have pause because I don't think inflation expectations, like public and businesses, they're not as stable as they used to be, right? We've all lived through higher inflation. There's a potential here that as more and more people see higher prices for the things they're buying, right, that they start expecting higher prices to continue, right? Firms may be more willing to pay higher wages because You know, maybe they think they're gonna get higher prices, and so you could get a longer lasting impact. And I think we saw that during the pandemic. That's why I mean, I think it's fine to say that's the most likely case, but I really think we should entertain the possibility that it could be a longer lasting problem. The fact that we haven't gotten inflation back down to 2% gives me pause.
And there's another aspect of this I'd like you to touch on, having to do with FOMC attitudes, which is the Fed signed on pretty explicitly to the team transitory side of what was going to happen from the pandemic in terms of transitory supply shocks, and got badly burned. I sometimes wonder how much the committee was seared by that experience and therefore really doesn't want to do it again.
I'd say many were seared, right? So like Austin Goolsbee, for one, right? He says, right, I thought it would be transitory then, I'm more cautious now because of that. So I do think there is part of the FOMC is taking that into account. Part of it thinks that the equilibrium interest rate is higher. Part of them thinks there's not much room to cut anyway, so even if you wanted to support the labor market, you don't have as much to do. So, I mean, but that's what you see in those dot plots. You just see a disparity there that often at this point during the year, you wouldn't see as big a disparity in 2020. The 2025 is, you know, we only have 2 more meetings, and yet you're seeing a big disparity there. So there is different views on the committee.
It's not that big if you ignore the Myron dot. You showed it up there.
Yeah, I don't know.
I mean, it was there.
Yeah,
It was there.
Yeah. So, I mean, one of them didn't want to cut it all,
Yeah.
including last meeting. So.
Yeah. Yeah, I wanted to ask you a quick question about that. If you look at the dot plot, which you showed, leaving aside Myron, all the non-median voters were higher than the median. The market doesn't seem to have taken any notice of that or remarked about it. It was a funny kind of a median, right? Yeah. Everyone who's not at the median is higher than the median. And it is literally the median because you look for the 9th and 10th voters. But you noticed that too.
Yeah. But not unreasonable, right?
No, it's just a question of whether the committee, once you get them off the median, is sort of tilting hawkish or tilting dovish.
I mean, to be fair, right, I'm only showing the dots, right? If you look at the economic forecasts that generate this as being the appropriate policy, you don't see anyone really thinking that we're going to have a recession or a big, pullback in the employment. You don't see a bad. You see some increase in the unemployment rate a little bit, but you don't see it really bad. So I don't think this is unreasonable.
Mm-hmm. Okay, I want to ask you one more question, then open it up to the floor, and that's about AI, which I think you raised. You showed me productivity.
Yeah.
Looking much better in the last few years than it had in the past. So some people think the AI is bringing on a quite large and long-lasting, both positive, good supply shock, not a bad supply shock. So I'm wondering what you think about that, both in terms of size and how lasting is this. A lot of these supply shocks are one shot. The AI thing, whatever it is, doesn't feel or look like one shot.
Right. So I guess I'm not an expert in this in any way, shape, or form. But I do think there's potential here that this could be an incredibly important, positive development in the economy in terms of productivity growth. However, the one thing we always, if you think about trade, the same thing. We know free trade is better for economies, but we have learned that not everyone gains, right? People are hurt, transitions are hard, and I think we perhaps didn't take it as seriously as we should have in terms of the transitions. AI, I think, is going to be the same. There are going to be some people who benefit very greatly from it, no doubt. Businesses, people's lives. But there are going to be people who are hurt by the transition. And if we ignore that, I think that's a potential cost. Maybe not in the long run, but in the short run. And it may have political implications, et cetera. So I think that's something we should take into account seriously.
Yep, so do I. So do last year's Princeton graduating class, by the way.
Well, yeah. I mean, that's the other thing, is like, this charts I've been showing right there are sort of like the overall macroeconomy. But if you look deep down, you can see that, you know, the higher income is doing very well, right? The stock market's booming. You have lower income people and new employees and new college graduates where the labor market is not very good at all. And so there's this disparity that also is kind of characterizing this uneasy balance in the labor market, I guess.
Well, thank you.
Study.
Let's take some questions from the floor.
I'm going to go to a student first.
Say who you are and ask your question. And a question.
Yes.
I don't have to tell you. You'll ask a question, I know.
Thank you for the presentation. I'm Oren. I'm a senior in the economics department. And a question on this last point about the disparity between the high income and the low income. In a recent piece, Scott Bessent basically accused the Federal Reserve of being responsible for inequality in the economy. What would your response to that be? And how do you think the Federal Reserve going forward should communicate or make sure people understand what it's doing and what effects it has distributionally?
I mean, I would say any policy, whether it be a Fed policy or a Treasury policy, is going to have disparate impacts, right, on the population. I don't think, and that's true of Fed policy, right? I mean, it has like the tool of interest rates, and you know, if you're a saver and a borrower, you're going to be affected differently by that. So I don't think that's an issue, and I think everyone recognizes that. But, you know, at the Fed, we don't have something that can direct, right, and have, you know, an effect, beneficial effect on all groups, right? What we try to do is set an interest rate, right, that's going to achieve maximum employment, but importantly, price stability, and that's the best we can do for the overall economy. And if we do that, given how difficult that is, I think that's the best we can do. I don't believe the Fed is responsible for income inequality in the United States.
Do you think it was a mistake for the Fed to sort of lean in that direction? The language is something about inclusivity. I don't quite remember what it said. Yes, you do.
Yes.
Yeah. So do I. Though I'm a big believer in the cause, but it's for the reason you said. The Fed can't do a damn thing about it. Basically.
Now I have the expert.
Introduce, say who you are.
Aishigu Shahin from Princeton. Thank you for the great presentation. So as you know, there was a framework review and framework change. But despite that, we proceeded with cuts and with signal that more will be coming. And if you look at the labor market, you nicely explain why we should expect lower payroll growth. There's really nothing flashing right. So did we make a mistake by committing to this? Or and what would you have now if you are on the committee?
So I see higher inflation risks than they have articulated they do. At least, you know, I'll take Powell as the thing, because some of the other, you know, Bostic, who's the president of the Atlanta Fed, he came out and said he's supporting no more cuts and things like that. I can understand why they decided to do 25, because I think the 30 is below, kind of 30,000 per month is below, right, what they think of as the break-even rate. Even most estimates have it above that. Not much above it, but above it. And if you believe that policy is restrictive at the moment, right, 25 kind of, you know, you're trying to balance, so you could do a cut to try to support the labor market and at the same time keep policy restrictive for the inflation side. What I didn't like about it is that there was no real pushback at the press conference about like the market's overthinking that October and December are done deals. And then in the speech yesterday the chair gave again, didn't seem to push back on the notion that this is the first of a series. And that would bother me, because I think you should really be looking at how the economy's, evolving. And it could be that maybe the labor market's weaker than we think. It could be that something's happening there that we don't really see. We know that there's just cross currents on supply. But right now, I think they should be much more focused on some of the issues that's going to happen on the inflation. Well, not much more focused than they've articulated about their inflation concerns. They've leaned too much into the one forecast that it's all one-ofs, price level changes, and not enough anticipating that there are other scenarios that could play out. So I'm a little bit more of the be careful, don't cut discriminately, be careful.
Potential decide.
Yeah.
There's one in the back. You enjoying having freedom of speech back?
Oh, yeah.
Hi, my name is Prem. I'm a PhD student here at Princeton. I think it was brought up earlier that we seem to be in somewhat of a two-speed stage in the economy right now among different income strata. How does this inform the Fed's macro policy going forward, as well as what brought us to the stage in terms of the Fed's actions?
Well, we kind of hit on this earlier about sort of the Fed really can't focus its policy on one group or another. But that said, right, there is a lot of analysis of sort of the breaking apart what's happening in the economy in terms of income, right? Because, you really want to be able to build down and up, right? So a lot of times the micro data is informing you about where the economy is going to go in terms of the outlook for the economy. So those micro data divided by income is good information that you want to see in terms of, is your expectation that, consumption is going to continue rising, at a good pace or not? That matters. Right now the stock market is doing really well, but if majority of the consumption is happening at the high end, if that changes, then maybe you're going to have a slower growth of GDP than you thought, because consumption is going to slow more than you think it is. So the microdata is informative of macro policy, but we don't set macro policy because we think we can affect the micro, those sections of the economy. We set policy to hopefully give a strong, basis, and then different people are affected differently. But if the Fed can achieve the two goals that's been given, which is stable prices and the employment rate that's sustainable with stable prices, I think that's pretty good for the economy. And that's how we go about setting policy, with that in mind.
Dana's coming behind you with a microphone. I forgot, identify yourself. I forgot the last.
Sure. Thank you so much. My name's Amy Ho. Thanks for having me. I'm from JP Morgan Research. So you've actually mentioned the Fed's dual mandate, and I was at a recent speech with Stephen Myron earlier this week where he was asked about when he mentioned a third possible mandate, which is moderate long-term interest rates. Could I get your thoughts on this possible third mandate? I know that Ben Bernanke has said it's kind of mixed in with price stability.
Right.
But the Trump administration could argue that the Fed is not achieving its full mandate. Thank you.
Okay, so you're right. If you look at the Federal Reserve Act, right, it does have that in it, right? So it's maximum employment, right, price stability, and moderate long-term interest rates. And, right, the Fed has always said, right, that if we achieve the dual mandate goals, which we talked about, you will get, right, moderate long-term interest rates. And so that's kind of how the Fed goes about doing its business in terms of the goals that it's set out. You can't really set interest rates independently, right? So I know the Trump administration has argued that they want to, I mean, this is the thing that I find kind of interesting, is that a lot of the things that they want to achieve, some of the policies they're enacting actually go against it, right? If you undermine the credibility of the Fed and the independence of the Fed, you're going to end up with higher long-term interest rates, not lower ones, because it's counterproductive in terms of there's going to be a risk premium that everyone's going to demand because I'm not sure that I want to hold long-term government debt. So that's true of a lot of the things that they're doing. So again, if you try to focus on, I just want moderate long-term interest rates and lower the interest rate, which is what his dot up there is suggesting, I don't think you're going to end up with price stability or maximum employment. So you need to be consistent. And so what the Fed has done is said, okay, our policy tool affects these two. We don't really control the long-term interest rate, right? But if we set these so that we get price stability and we get healthy labor markets, we'll get moderate long-term interest rates.
If you want to be charitable about this view, you would say that that third one is, but this is not what Congress was thinking. It was focused on the real interest rate, which the Fed can't control anyway. I said if you want to be charitable.
I don't have to be now.
You don't, neither do I.
Hi, thank you so much for the presentation. My name is Shirley. I'm a PhD student here. So one thing I was curious about is institutions like the CBO make their projections based on official policies that are announced, but businesses and consumers, investors probably make some decisions based on, say, social media policy making. I was wondering if you think the Fed should kind of reconcile this discrepancy when it comes to policy making, as well as if there are periods from history that we can draw lessons from when there's particularly high policy uncertainty. Thank you.
Well, there's a lot of people making forecasts, right? I mean, I think it's good for the CBO to assume current policy because I don't want them sort of predicting what is going to come out of, you know, their policymakers. So I think that's a good forecast. But there's a lot of private sector forecasts, right, that are available that actually anticipate sort of what, you know, policies are going to be, right? The Fed dots, for example, that's a forecast. That embeds in it, you know, each policymaker's view of what they think fiscal policy may be and what they think the effects are. I mean, lots of times at the Fed, you don't comment at the Fed on whether it's good or bad, but you do take into account what fiscal policy will mean for growth and employment. And, you know, just the chair's saying, you know, tariffs are going to affect price levels, right? You're taking into account fiscal policy. So, I think it's taken into account when you're setting monetary policy. It's just that the Fed will not comment on whether it's a good policy or bad policy. CBO is different. They work for Congress. They're going to take into account, if we just assume, you know, current policies stay, this is what the forecast is going to be. That's helpful information. It may not be a prediction of exactly what's going to happen. Just like this dot plot that's shown back there, right? You're writing down what you think appropriate policy is. That you might have a different forecast if you were asked, what do you think the Fed's going to do? Right? I mean, when you're in the Fed, it's kind of weird to ask the question of yourself. But knowing you can't control the Fed, you know that your dot may not be what actually happens. And if you were asked two different questions, you would see it differently.
There have been a couple of times in history where the current policy forecast was so at variance with what everybody thought was going to happen that the CBO showed too. But your answer is basically correct, that they don't want to be second guessing Congress.
Hi, good afternoon. Thanks so much for taking the time. My name is Christian. I'm a first-year master's student here at Princeton. My question to you is about dissenting votes. We went through a long period where there was consensus. Recently, there's been more dissents. I was wondering if you could reflect on your own calculus for whether or not to pursue that and what you make of potentially this new era where we're going to see a lot more of that. Thanks.
Okay, so I have dissented, so I'll talk about my calculus for it, but I think dissents per se aren't a bad thing or necessarily a good thing, but I think of them as a good thing in the sense that, right, if you have an uncertain environment, and I would submit we're in an uncertain environment now, dissents are basically showing you that people are thinking, there isn't groupthink, that there are different people coming around that table with different views of the world, different, economic analysis, maybe different data if they're looking at things that they take into account more than other policymakers, and they decide I can't support this policy. So, would it be a problem if everyone dissented against, the chair? Probably, right? But we're not there yet. And I think dissents in an environment that's uncertain like it is now actually show a healthy institution, not something to be feared. My own calculation when I did it, and I did it a couple times, I don't remember how many, but I kind of didn't, I went in thinking that I kind of wanted to see if I could support the chair's position, right? So when I always thought of policy, it's like, okay, can I really support this? I didn't want to dissent because I got publicity or whatever. I wanted to only dissent if I really thought I just can't get there. And so I had to do it a couple times where I just thought this wasn't the right thing to do. And then you make your point, and then sometimes the next meeting, either they would move or you would move back to, okay, I made my point, I'm not going to dissent 20 times in a row. Partly because if you ended up doing that as part of the committee, people wouldn't listen to you. So you got to be a little strategic about it, but you also need to, say what you have to do what you think is best, and always focus on sort of what's best for the economy and trying to achieve those goals. So different people, I think, have different perspectives on when they would dissent and when they wouldn't. But I kind of always thought, like, can I support it or not? Like, I think the difference now with, like, the October meeting is, how I would characterize what they're going to do is, I think that the conversation has changed in the sense that they're going to go in and look at the data and say, does the data tell me I shouldn't cut in October? Whereas before, they went in thinking, is the data telling me I should cut? And so that's why I think they're leaning towards cuts. And I don't think that's necessarily the right thing to do, but I suspect that's how they're going to be thinking about it.
One more question.
Hi, my name is Tuncho. I'm a master's student here. Very quick question about the balance sheet. Given the changing monetary policy environment and expectations, how do you foresee the balance sheet policy changing? Do you think it's going to keep lowering, or they're going to try to keep it stable? Also considering the treasury market instability that we've seen recently as well.
Yeah, I think they would like to have it get lower than it is right now, but they also don't want to repeat what happened in September 2019. So, they've been sort of like, if you look at the the best way to look is the minutes of the FOMC meetings. You'll see that they have had more fulsome discussions about, are they getting close to the point where they want to sort of just stabilize for a while. And I think they're getting closer, but I think if they can keep it going through at least the first quarter next year, they'd like to, but we'll see. It'll depend on what happens in the markets, as you point out. I think they don't want to have a repeat of the instability they saw before.
Please join me in applauding Loretta and her newly found freedom of speech. Thank you, Loretta.